Hey traders, welcome to Charts and Coffee. Great to see everybody. Happy Tuesday. We are winding down the year day by day, looking at equity markets making new highs. This is very much in line with what we've been seeing with the sector strength in technology, in communications, consumer discretionary, and semiconductors. We've talked about how important it has been for financials to have joined the party. So now we have the formula of technology plus financials, XLK plus XLF, leading to outperformance in the S&P. And higher highs we're seeing right now, right? We're taking on 4,800. And this goes back to, gang, I hope something that I know a lot of the Sector Secrets Mastery folks and folks that I've been talking to throughout the year, there's been a big adjustment. And I got an email just, it was Sunday, about someone who says, Rog, I realized two things. And I understand now what you mean by trade what you see, not what you think. There have been a lot of folks sharing what they think. The markets are going to tumble. The Federal Reserve doesn't know what they're going to do. The markets are overbought, whatever, right? We've all been there. We all know, we listen to this on television. We have a whole television station dedicated to what people think as opposed to what we see. The markets don't have to do anything under this, some kind of idea of logic, right? The US dollar can continue to rally and equities can climb. Bond yields can be higher and equities can climb, right? We see the Federal Reserve can hike rates and equities can climb. All three of those things we've seen this year. So the less we try to compartmentalize something into, if this happens, then this must, especially when it comes to macro and data, hopefully that's something that a lot of traders are carrying into 2024. And remembering, look, I'm going to take the other side of this. Just because the Federal Reserve is cutting rates doesn't mean the markets have to rally. Right? So let's make sure we're being even keel about this. We have to trade what we see. And if evidence of the uptrend persists, as the clarity, say, in the NASDAQ has been bullish since the middle of November, or as the clarity in the long bond is now bullish as of the first week of December, if the proof is visually in front of us, then we'll continue to follow the structure. And I think that alone, if you never listen to another thing ever that I were to say again and just took that idea with you and apply that to your trading, it would make a sea change in what you're doing. And I'm rooting for you. I'm rooting for the retail trader. I'm rooting for that person who takes their own money, puts it into the market, and manages risk. I'm rooting for you. And I think those are going to be the way that if you're looking to turn the corner, that's it. So in terms of, someone says the Fed has to cut rates, that's news to you. My friend, I would look at the data because that's not anything surprising. That's been established for months now. And I would absolutely probably tune into Charts and Coffee a little bit more often because that's exactly where we're heading, to rate cuts. If anyone tells you otherwise, they are guessing. They're not using data. I can promise you that much. All right, so let's go ahead and get to the questions here. And Jim asks, at Forex Factory, what other? Oh, okay. So in terms of the question is, what kind of data do we use? Sure. Where do we get our data from? Sure. First of all, Forex Factory. In fact, the term hot zones that I coined back in my first book came from the little red icon on Forex Factory. This site's been around for over 2 decades, and this is a perfect way to understand not just the U.S. calendar, but the global calendar, because we know that other central banks, like the Bank of Canada, like the European Central Bank, can affect what's happening in the U.S. economy, just because other central bank monetary policy and opinions can have a little bit of a ripple effect, right? So there's a really good reason Forex Factory is a great place to start. Trading Economics would be the next one. So tradingeconomics.com. This one, you've got to go in and I would clear out all but the US, save that. Really good economic calendar. There are certain events that will be posted on Trading Economics that you will not see on Forex Factory. The third calendar, specific to the fact that sometimes FOMC speakers and other central bank speakers are not going to be listed occasionally at Forex Factory and Trading Economics. Econo Day, the The calendar over at Econo Day seems to have a little bit more thorough a listing of FOMC speakers. And as we go into, by the way, since we're talking about economic calendars, as we go into earnings season, I will use Estimize. In fact, in the Sector Secrets Mastery, we're already preparing for earnings season because we're that 6-week window out. Now is the time to think about which stocks, which sectors are best primed for that rally, that run into earnings. All right, next up is looking at a question on, hey there, Cindy, when the Fed cuts rates next year. Sure. Now, gang, when I talk about rate cuts, all right, here we go. We're going to the Fed Watch tool, and this is where a lot of traders look. This isn't absolutely what's going to happen, right? I mean, obviously, there's no absolutes, there's no certainties in trading, or certainly in the markets, and most definitely not in macroeconomics. But what we're doing is looking at the fact that on the March 20 meeting, there's nearly a 66% expectation for the rate cut. Now, the reason this matters is unless the Federal Reserve has messaging that has us as traders and investors walking down our expectation, if we're still at 65, 75, 85% come March 20 for that 500 to 525 column, and we do not get a rate cut from the Federal Reserve, it will be anarchy, right? It will be a disaster, because this is as much a reflection of what we collectively are expecting as it is a communication device to the Federal Reserve, letting them know this is what we expect from you, dare I say demand, right? And that's where this is a two-way communication device. Of course, if the Federal Reserve takes one look at the March 20 Fed Fund futures, and believe me, they've got these up in their Bloomberg terminals. If they look at that and say, whoa, we have way too high an expectation for our making some sort of move in March, what you will see is the Fed members will begin to talk a little less dovishly, because they've got a way to measure our expectation. They'll start talking dovishly in a way that aligns these Fed Fund futures target rate probabilities to what they want us to expect. It's a very interesting dance that happens here. So that's how we look at this. Is anything set in stone? It's only as set in stone as the Federal Reserve is willing to move these around. But right now, gang, believe me, if we don't get that quarter point cut, it will be a shock to the system. And Jerome really doesn't want to do that, right? He's done it before. He's not looking to do it again. So the question is, when the Fed cuts rates next year, would it be the stock market at its worst, or when the market is high and dandy? I don't understand the question. Is there a correlation? Again, Cindy, everything, my diatribe at the beginning of the show was, we don't want to be in a correlation environment of, if they do this, then that'll happen. We have to constantly assess. So if I'm understanding the question right, is if the Fed cuts rate, will the equity markets continue to go higher? What we want to ask is, if the Fed cuts rates, right? If the Fed cuts rates, do we still keep the uptrend? And that's what I would tell you we have to consistently monitor. Now, if for whatever reason the equity markets were to move substantially lower, I don't know for what reason that would be. I mean, I can't even think of a geopolitical reason at this point. I mean, if there's anarchy and aliens are hovering over Manhattan, that'll only make them cut rates more, right? We know the Federal Reserve will protect the equity markets to a certain degree. So how about we just study what's happening, right? And look at the way in which expectations for cuts accompany the potential uptrend. So if we continue to observe, right, look at the data, PCE is on Friday, and we continue to observe and see the market moving higher as expectations for rate cuts increase, that is going to be the best way, I think, to do that, right? Keep in mind that things can change, but more importantly, know how to measure that change, right? Know how to measure that change. So I hope that helps, Cindy. Next up, Munair asks, I went back and looked at my videos on the Darvis 2.0. I see the indicator on your charts, of course, but would you say that you have a slight preference to DPMRs these days? Munair, no, they're two different tools, right? it's like saying one ingredient in a recipe is that much more important than another, which could be true, but while a cake is mostly flour without the sugar, it's just bread, right? So I think everything has its place. What I would say though is if I'm looking for support and resistance using historical volatility, and which has really been my preference in a volatile environment, I'd say, yeah, the DPMRs are going to be important. But if I'm looking for um, different levels where price has gone down to and respected that resistance or respected that support, nothing is better than the Darvis at doing that because it's automated, it's unbiased, it has no major opinion, right? It doesn't care that I'm bullish or bearish. It doesn't care that I have biases. It just shows that's where it is. When those layers can overlap with volume, when those layers can overlap with DPMRs, again, that's everything working in harmony. But DPMRs are working really, really well. And a lot of times you'll see Darvis is going to be in the mix as good volume for that matter too. All right. Let's see here. My thoughts on seasonal uptrends for oil, copper, small, mid-cap stocks in general. I'm just watching the market and have right now, BJ, I will tell you this. Once the Federal Reserve takes over the narrative, I would throw seasonals out the window. I know, Rob, but you do talk about seasonals from time to time. Seasonals are best applied to things that are planted, grown, harvested, stored. Please remember that. Now, are there seasonals for crude in terms of demand rhythms? Of course, right? There are even seasonals in terms of when they shut the refineries down for a couple weeks. Those are done on a consistent basis, a certain time of year as well. So when you're looking at a rhythm of something, I would not apply that to indices, treasuries, or currencies as we're going into increasingly more dovish central banks. So right now, and I'll tell you, if a particular market has been ignoring its seasonals in the recent, use some recency bias, right? If the seasonals are not being respected now, and largely they really haven't been, I would not apply them. So seasonals have to show us, that they've been working up till now for me to project them forward, looking for some clarity. So I would say right now is not the time for looking at seasonals, frankly, at all. And so with that being said, let's just make sure we're watching the trends, make sure we're watching the trend in the target rate probabilities. And OPEC, as far as you mentioned, crude, right? Oil, yeah. So OPEC is going to be the central bank for crude oil. And if we have OPEC trying to saber rattle, or if they increase the production cuts, or another way of saying that is they decrease output, then that could send crude higher. But the best way to see crude move higher is not when OPEC manipulates output. The best is demand. So if you're looking for where crude is going to start moving higher, I wouldn't look at seasonals. I would actually look at EIA, IEA, API, and just the general narrative around demand for crude. Demand for crude and demand for copper will go up when there's economic optimism. That's typically the way that it will move. But again, I say typically, we still got to measure it and make sure it's being responded to in kind. But ultimately, when I'm looking at crude oil, the best narrative for an uptrend or a recovery from the downtrend that we're in to get back above the 200 period exponential moving average, it's going to be a demand narrative. That output is not exceeding demand and that demand is growing. And right now, obviously, in things like natural gas and in crude oil, when there's more supply than demand, supply is what, gang? Supply is just a fancy way of saying resistance. And demand is just a fancy way, maybe not even that fancy, really basic way of saying buyers and support. So I would probably put the seasonals on the side. Yeah. All right. Caterpillar on a 1 hour chart. Cat's a good looking part of the XLI, Mr. Walker. Yeah, I agree that Caterpillar, and if you take a look at Boeing and GE, there's a number of stocks within the XLI that look really good. And as long as we have expectation for the XLI to climb, for the Dow to climb, the relative outperformers in the XLI are fair game. So yeah, I think Cat's been one of those candidates. Although if I were to compare Caterpillar's uptrend to GE's uptrend, or to say Boeing's uptrend. Caterpillar's uptrend is rather recent. So it's most recently starting to move higher, right? So in terms of an uptrend being established, even if I'm looking at the 1 hour chart, take a look at the daily there. It's not been in an uptrend for as long as the other two have been, but it's absolutely fair game. Keep an eye on the 283.60 area. But yes, absolutely a potential for movement to the upside. All right. Let's see what else we have here. Is that it on questions? I think that's it on questions. All right. So as always, gang, trade what you see, not what you think. That's what's kept us bullish all year. Please don't think correlations matter, because we were just busting some myths. We had our very own myth buster issue of the top tier outlook, where I hope that the month, as we wrap up the year this month, or the month of December, we look back on 2023 and say, wait a minute, were there some things that we have not been doing that we really needed to do? Or were there some things that we believed that aren't really true? What are they? The Russell does not lead the market. I hope that we've killed that once and for all. It does not lead the market. Nothing leads the market, right? We look at composition of indices. The US dollar does not need to be weaker for the equity markets to move higher. That's been defied all year. Treasuries, we can see higher yields and still see higher equity prices. We've seen that all year. Right. So some of these things, we want to make sure we can detach from, because they don't have the data to support it. And I think 2023 was a really, really good reminder of that. All right. Wrapping up the show. Eddie asks, I have daily options. What is the point of looking into the hourly chart? So Eddie, it's time horizon. So time horizon is dictated by time frame. I don't day trade off a daily time frame, right? There's no sense in that, because it's too long a time frame to handle a time horizon of today. So each time frame has one second here, gang. All right, so each time frame has a job, right? So when you ask if I have daily options, what is the point of looking at the? There may not be any point, Eddie, if that's what your plan is. I don't know what your plan for the daily option is, right? But the point of looking at the 1 hour time frame is to have a shorter time horizon. 1 hours are really going to be good for, say, 1 to 3 days on average, right? They're not going to take me deep into a trend over the course of weeks the way a daily could, right? Same way if I'm looking at a day trading time frame, I'm not interested in day trading, say, a 1 hour chart. I'll look at a 5-minute chart. And then if I look at the 5-minute, what that's going to do is map to having enough candles happening quickly enough where I can get a setup, a trigger, and a follow through within a smaller period of time, right? I won't get that on a 1 hour or even a 30-minute. So each time frame is going to project to a certain time horizon. For me, 5-minute for day trading, 1 hour for 1 to 3 day time horizon, meaning how long could we possibly be in the trade? And then daily is going to take me, say, 2 to 10 days, maybe weeks. So again, when your time frame's longer, your time horizon could be longer too, right? So Eddie, always look at whatever your setup may be, and you might not have any use for the 1 hour because you want to trade to last for weeks, right? So pick the right time frame for the job. And by the way, as we wrap up, that also means I do not use multiple time frame confirmation. Each time frame has a job. It's not looking to the 5 or to the daily to have it agree with it. So each time frame has a job, which is the opposite of what multiple time frame confirmation is. All right, gang, as always, thank you so much. Hey there, Nomo FOMO, caffeinate and dominate. Oh my gosh, I just finished up the last little bit of the beans that are in my espresso machine, and I'll be having some Nomo FOMO blend going in there this afternoon. Fantastic to see you, my friend. I have been enjoying the heck out of that coffee. All right, gang. Thank you as always for all your questions. I do appreciate them. I'll see you tomorrow. Same time, same station.